Today, we're doing a complete breakdown of ASC 321. We'll cover the scope, core principles, measurement, journal entries, and real interview questions. Whether you're studying ASC, prepping for a Big Four interview, or working in finance, this is everything you need to know. Before ASC 321, equity investments often lurked in financial shadows, underreported or inconsistently valued. Imagine a firm with $5 million in equity securities, yet treating it as a minor footnote. ASC 321 demands clarity, defining how entities should measure and report these investments. By understanding this, you'll grasp how transparency enhances financial statements, ensuring investors see the real picture. ASC 321 emerged to tackle the varied treatment of equity investments, which caused inconsistencies in financial reporting. Imagine a portfolio with non-controlling shares valued differently across companies. This standard enforces fair value reporting, enhancing comparability and transparency. If a company holds less than 20% in equity securities, ASC 321 guides their accounting, making reports clearer and more reliable for investors. Entities with non-controlling equity investments had to adopt ASC 321 for fiscal years after December 15, 2017. This means 2018 was a turning point for financial disclosures. The core requirement? Measure equity securities at fair value, recording changes through income. Whether public or private, this uniform approach ensures transparency. It's vital to comprehend this shift for accurate financial analysis and reporting. ASC 321's Equity Securities Measurement Model requires equity investments without significant influence to be measured at fair value. Changes impact net income directly, shifting away from the historical cost method. Consider a company holding $2 million in marketable securities. Under this model, unrealized gains or losses hit the income statement. Comprehending this model is crucial for interviews, showcasing your grasp of contemporary accounting practices and ASC 321's importance. Scope matters because financial standards can determine how investments are reported and analyzed. Candidates often forget that debt securities are not covered by ASC 321, and that's a classic interview trap. Understanding these boundaries ensures accurate financial reporting and can make or break performance reviews. Let's explore how this standard applies specifically to certain equity investments. ASC 321 focuses on equity investments without readily determinable fair values. Think about private equity or small stakes in companies where no active market exists. Unlike the equity method, which requires significant influence, these smaller stakes fit ASC 321 perfectly. For instance, investing in a friend's startup falls under this standard because there's no market price to guide valuation. Knowing what's excluded from ASC 321 is crucial. Debt securities, for instance, are governed by different standards, often tripping up candidates in interviews. Investments in subsidiaries require consolidation, and joint ventures use the equity method. Both excluded here. Derivatives have their own rules. Misclassifying these can lead to significant reporting errors, so keep these distinctions clear and sharp. Equity security represents a stake in an entity's ownership, such as common or preferred stock. Imagine owning shares in a private tech firm. These shares aren't just pieces of paper. They grant you voting rights and potential dividends. However, don't confuse them with debt securities or derivatives. They are distinctly different and have separate accounting treatments. Fair value represents the price for selling an asset in a structured market transaction. Consider a private equity stake with no public trading. Fair value isn't just about numbers, it reflects what informed buyers and sellers would agree upon. This measure requires judgment and market insight, steering clear of historical costs or book values, which may not reflect true market conditions. Scope edge cases can be tricky. If you're holding equity in a private LLC without a market, ASC 321 applies. Preferred shares in unlisted firms? Yes, they fit. Small tech startup stakes also fall under this standard if no active market exists. However, publicly traded stocks typically aren't under ASC 321 unless trading is highly infrequent, requiring different evaluation. Imagine investing in a startup but not knowing how to report its value on your financial statements. ASC 321's Equity Securities Measurement Model addresses this, transforming uncertainty into precise reporting. This model is crucial for companies, especially those with substantial portfolios, to reflect true financial positions and make informed decisions. The Equity Securities Measurement Model structures how companies measure equity investments, ensuring transparency and consistency. Our example follows Meridian Corporation with a $10 million SaaS contract, comprising $8 million for a software license and $2 million for implementation services. This model guides us through identifying, classifying, measuring, recognizing changes, and assessing impairment, crucial for accurate financial reporting. Start by identifying equity securities, focusing on ownership interest. Meridian Corporation's $10 million SaaS contract includes $8 million allocated to a software license, classifying it as an equity security investment. Many confuse equity with other instruments, but remember, equity means a stake in net assets. This clear identification sets the stage for our next step. Classification hinges on the investment's intended use. Meridian Corporation's $8 million software could be trading if held for quick resale or available for sale for longer-term holding. A common error is misclassifying based on market trends instead of intent. Classification directly influences how we record value changes, leading us into measurement at fair value. Fair value reflects the price at which an asset could be sold. Meridian Corporation's $8 million software needs valuation using current market prices, factoring in liquidity or control adjustments. Many overlook these adjustments, skewing reported values. Correct measurement grounds the investment's value, preparing us to recognize changes in financial statements. Changes in fair value impact financial reports differently. For Meridian Corporation's $8 million software, classified as trading, fair value adjustments hit net income directly. Confusion often arises between net income and other comprehensive income. This step's output affects how financial health is portrayed, setting up for a final impairment assessment if needed. Impairment assessment determines if declines in fair value are temporary or lasting. Meridian Corporation's $8 million software requires scrutiny for any persistent dips. Mistakenly labeling temporary declines as impairments distorts financial health. Concluding our model, only significant non-temporary drops are recognized as impairments, ensuring accurate financial portrayal. The measurement method you choose directly impacts your balance sheet. A wrong choice can overstate assets by millions. ASC 321 provides options for measuring equity securities, and it's crucial to disclose those choices. This ensures transparency and aids investors in assessing the financial position accurately. When first recognizing an equity security under ASC 321, it must be measured at fair value on the acquisition date. If the fair value isn't readily determinable, use the transaction price. This choice impacts the balance sheet directly, as recognition occurs when control transfers, not necessarily when paperwork is finalized. For instance, acquiring 10,000 shares at $50 each requires precise timing to avoid misstating assets. Ongoing measurement of equity securities under ASC 321 involves fair value adjustments with gains or losses reflected in net income. When fair value cannot be determined, a cost-based measurement alternative applies, which includes regular impairment tests. For instance, if a security's observable price changes, it triggers remeasurement, affecting financial results. This dynamic approach ensures accurate representation of asset value over time. In financial statements, equity securities are distinctly presented under ASC 321. They show up as current or non-current assets on the balance sheet, while fair value changes flow through the income statement. Transparency and disclosures is crucial, especially if using a measurement alternative. For example, a $2 million fair value gain or loss directly impacts net income, highlighting the importance of clear presentation for investor interpretation. ASC 321 mandates specific disclosures that are crucial for transparency and investor confidence. Companies must disclose fair value and its determination method, especially if opting for a measurement alternative. Reporting significant fair value changes and recognized impairment losses provides insight into financial health. For instance, a $500,000 impairment signals potential asset risks, making these disclosures vital for thorough financial analysis. Imagine a CFO managing equity investments under ASC 321. For a $5 million investment, fair value measurement is straightforward due to active market pricing. However, a $2 million investment without market quotes demands a different approach, using a measurement alternative with rigorous impairment testing. Every decision affects financial statements and investor perception, underscoring the importance of thorough disclosure and accurate measurement. Balancing these factors is key to maintaining financial integrity. Meridian Corporation, a global manufacturing powerhouse, invests in a $1 million $200,000 equity stake in a local tech startup. Discover how this investment impacts their financials from acquisition to potential disposal under ASC 321. The initial investment in equity securities is recorded at cost, reflecting the cash outflow from Meridian's reserves. ASC 321 mandates that equity investments be recognized at fair value or cost if determinable. This transaction marks the beginning of Meridian's strategic expansion into the tech sector. ASC 321 requires that equity securities be measured at fair value with changes recognized in net income. Here, Meridian's investment appreciated by $50,000, boosting the value of their equity securities. This adjustment showcases the potential profitability of Meridian's strategic investment choices. When dividends are received, ASC 321 directs that they be recognized as income, reflecting immediate profit realization. This $30,000 dividend boosts Meridian's cash reserves and mirrors ongoing benefits from their strategic investment. Viewing dividends as income highlights the tangible returns from equity positions. Under ASC 321, if an equity security's fair value falls below its carrying amount, an impairment loss is recognized, impacting net income. This $100,000 adjustment reflects market volatility, reminding Meridian of the inherent risk in equity investments, emphasizing the need for vigilant financial oversight. The sale of equity securities needs to be recorded at the amount received, with any gain or loss impacting net income per ASC 321. Meridian's sale at a $100,000 gain demonstrates a successful exit strategy, turning their strategic investment into tangible financial results and enhancing shareholder value. Every Big Four and investment bank interview on ASC 321 follows a pattern. Here are the 10 questions that come up again and again, with answers that will make your interviewer nod. ASC 321 deals with the accounting for investments in equity securities. It exists to ensure that companies recognize and measure these investments at fair value, providing transparency in financial reporting. A common mistake is confusing equity securities with debt securities. Remember, fair value changes impact net income unless an election to measure at fair value through OCI is made. Equity securities excluded from ASC 321 are primarily those accounted for under the equity method, or those resulting in consolidation. This exclusion exists to avoid double counting in financial statements, and to apply more relevant standards like ASC 323 or ASC 810. Always check the level of influence or control to determine the correct accounting treatment. Under ASC 321, changes in fair value of an equity security are recognized in net income. This approach emphasizes income statement transparency. For example, if a stock's fair value increases by $10,000, net income reflects this gain. Avoid assuming fair value changes go to other comprehensive income without election. Memorize, fair value changes hit net income unless opted otherwise. ASC 321 focuses on fair value through net income, whereas International Financial Reporting Standards 9 allows fair value through OCI for strategic investments. Indian accounting standard aligns closely with International Financial Reporting Standards. A critical misstep is neglecting these options in International Financial Reporting Standards. Key takeaway: recognize how fair value impacts differ across standards and adjust strategy accordingly. Dividends from equity investments are recorded as income under ASC 321 unless they represent a return of capital. For instance, receiving $5,000 in dividends would increase income by $5,000. Avoid confusion with return on investment. Remember, dividends impact income unless they're capital returns. Reclassification under ASC 321 involves moving securities from one measurement category to another, affecting how gains/losses are reported. A $20,000 gain under fair value might shift from net income to OCI if elected. Missteps often involve overlooking reclassification impacts. Memorize, category changes alter financial reporting drastically. Fair value changes under ASC 321 directly hit the income statement, altering net income. If a security appreciates by $15,000, net income increases by the same amount. A common oversight is forgetting this direct impact. Key takeaway: fair value movements visibly change income, affecting investor perception. Goodwill is not included under ASC 321. It's addressed by ASC 350. The trap lies in misclassifying intangible assets as securities, leading to incorrect accounting. Focus on distinguishing equity securities from goodwill for accurate reporting. Key lesson: always verify scope to avoid fundamental errors. CFOs must disclose fair value changes, measurement bases, and any impairments under ASC 321. They should detail the methods and assumptions used. Missteps can occur by omitting key fair value details. Remember, comprehensive disclosures ensure transparency and inform investor decisions. ASC 321 sets the accounting framework for equity investments lacking control or significant influence. Covering investments in marketable securities, it excludes consolidated subsidiaries and VIEs. Key definitions like equity security as an ownership interest shape the standard. Scope is precise, applying to equity investments outside ASC 310 or ASC 810. For securities without a fair value, the measurement alternative is used, ensuring consistency across similar investment types. The core model in ASC 321 revolves around measuring equity securities at fair value, impacting net income directly. For non-marketable securities, the measurement alternative applies in absence of a market value. Regular reassessment ensures fair value accuracy, while unrealized gains and losses directly affect net income. Impairment considerations emerge with the measurement alternative, especially when triggered by observable transactions. The fair value option offers flexibility for bill-eligible securities. In interviews, understanding ASC 321's nuances is crucial. Be ready to discuss key traps like misapplying fair value and the necessity of frequent reassessments. Differentiate it from ASC 320, focused on debt securities. Knowledge of disclosure requirements, market change adaptations, and transition guidance is pivotal. Recognizing when the measurement alternative applies can significantly influence financial statements, making it a vital area of expertise. Prepare thoroughly for these common interview scenarios. That's your complete guide to this accounting standard. If this video helped you, please like and share. It genuinely helps us keep creating content like this. Drop your standard requests in the comments. Subscribe to Candy Mentor for more accounting and finance videos.